When a trader sets his eyes upon the market, he must do so with the same quiet patience a sailor gives to the tides. Price has its own rhythm, its own natural law, and if you learn to recognize that rhythm, you'll often find yourself standing in the right place at the right time. Now, have you ever watched a market coil tighter and tighter, almost as if it were gathering breath for a decisive move, and wondered whether you should step in or wait just a little longer? I've spent many years studying how markets build pressure before a breakout. The movement is never random. It forms according to geometric proportion, time cycles, and the psychology of the crowd. Before a breakout, the crowd hesitates. They question. They doubt. That hesitation leaves a footprint on the chart, and as a trader, your task is to read that footprint like a map. Do you see how the chart begins to narrow its range, how volume stalls, how price tests the same boundary more than once and refuses to back away? These are not accidents. These are the clues that informed traders watch for, quiet signals that a greater move may be forming beneath the surface. Many traders chase the breakout after it has already run, but I have always believed the wise man positions himself just before the turn. Not with reckless certainty, but with measured reasoning. When price approaches a long, tested resistance line, especially one aligned with time cycles or square of price calculations, it often signals that a moment of decision is near. But let me ask you, do you wait patiently for that perfect alignment, or do you let impatience push you into trades that lack the proper foundation? The truth is, entering before a breakout requires understanding the balance between risk and probability. You must never assume the market will break simply because you wish it to. Markets care nothing for our desires. They respond only to supply, demand, trend, and time. The trader who seeks to enter early must anchor his decision in evidence, never emotion. When price presses repeatedly against a barrier without losing ground, when pullbacks shrink in depth, when the market begins forming higher lows under resistance, that is the market gathering strength. It's like watching a spring being compressed. Each test of that boundary tightens the energy. Still, the question remains, when should you step in? Many traders confuse anticipation with guessing. Anticipation is grounded in study. Guessing is grounded in hope. So I ask you, are you anticipating the market, or simply hoping it does what you desire? A trader who anticipates has already measured time counts, noted key price levels, and studied how the market behaved at similar junctures in the past. He understands that history does not repeat perfectly, but it often rhymes in useful ways. Now, before a breakout, the market often reveals a last retracement, a small decline that fails to reach previous lows, showing that selling pressure has weakened. This is where the early trader begins his consideration. Not a blind leap, but a deliberate step. You might see the market form what I used to call a higher bottom. Something subtle yet powerful. It is the market whispering, not shouting, that strength is building. Have you noticed how these subtle changes appear long before the crowd becomes aware of them? Another key principle is time. Too many traders think only in terms of price, but price alone is only half the picture. The true structure of a breakout lies in the marriage of price and time. When price presses against a resistance point at the same time it aligns with a significant time cycle, perhaps a 30-day, 60-day, or 90-day division, that is when the market becomes especially sensitive to change. You must ask yourself, is this move occurring when time and price harmonize, or is it happening out of season? Entering before a breakout also requires understanding your own temperament. Your mindset is part of your trading capital. A calm, disciplined trader sees opportunity, where a frantic trader sees noise. If you carry fear into the market, you will rarely enter early, because early entry requires confidence. Calculated confidence, not bravado. But if you carry greed into the market, you'll enter too soon, long before conditions justify it. So consider for a moment. What is the emotional cost of your trading decisions, and how often is that cost influencing your timing? The trader who seeks wealth in markets must treat capital with the same respect a farmer treats his seed. You don't throw seed into barren ground and expect a harvest. You wait for the right season, the right soil, the right signs of moisture beneath the surface. Entering before a breakout is the same. You prepare the ground by identifying trend, support, resistance, volume, time, and market structure. Only then do you place your seed, your capital, into the market with calm conviction. Sometimes, the strongest clues come from the simplest observations. Look closely at the range of the bars. Do they narrow as price approaches the boundary? That suggests the market is storing energy. Do the swings compress? That often indicates balance between buyers and sellers is shifting. Do you notice how the market often hesitates, just a moment before breaking through, almost as if testing your patience? This is why many traders fail. They jump out too soon, thinking the market has forgotten them, when in truth it was simply gathering strength for the real move. Another element to watch is the behavior of volume. Now, I never considered volume to be a perfect indicator, but it often adds valuable color to price action. Before a breakout, volume may contract. That contraction reflects indecision and preparation. Then, at the moment of breakout, volume expands. But the early trader does not wait for volume expansion. He has already taken his position based on structure, not excitement. So ask yourself, are you following the crowd's noise, or are you reading the structure that forms before the crowd arrives? Wealth in trading is not built by catching every move. It is built by recognizing the few well-aligned opportunities where price and time offer favorable conditions. When you learn to read the build-up before a breakout, you learn to position yourself during the quiet moments, before the marketplace becomes emotional. This is where the true edge lies. It's not magic, it's not prediction. It's disciplined observation of natural market principles. The trader who respects these principles grows not only in skill, but also in mindset. Wealth comes as a result of understanding how money flows, how trends form, how patience is rewarded. You begin to see that markets are not chaotic storms, but structured expressions of human behavior. Once you understand that structure, you are no longer reacting, you are preparing. And preparation, that is where real trading confidence begins. And as you look at your charts the next time the market tightens into a narrow corner and the energy begins to build, you might ask yourself, when you see a market testing the same level again and again, you're not just looking at random touches on a chart. You're seeing the natural process of pressure building, much like water rising slowly behind a dam. Traders often underestimate how much information is contained in these repeated tests. They look at the level, they see the price hitting it, and they think, well, it hasn't broken yet, so maybe it never will. But that kind of thinking ignores the underlying mechanics of accumulation and distribution, the forces that shape every trend. Let me ask you something. When you see a door pushed on repeatedly from the same direction, does it usually become stronger or weaker? Each time price presses into a resistance level, sellers meet it. On the first test, sellers often respond aggressively because they've been in control for a while. On the second test, they may still be strong, but something subtle begins to change. By the third or fourth test, you'll often notice the reaction is no longer as sharp. The pullback becomes smaller, and price recovers more quickly. The level that once rejected price with confidence begins to look tired. That tiredness is not a trivial detail. It's the market showing you where the balance of power is shifting. Repeated tests of a key level expose structural weakness. If sellers were truly dominant, they wouldn't allow price to return to that area so easily. A strong wall repels an attack and forces the enemy to retreat far away. A weak wall barely pushes the enemy back, and soon enough the pressure returns. Price behaves the same way. Have you ever noticed that when a level is incredibly strong, price bounces far away from it? But when price keeps coming back with little resistance, the strength of that level begins to erode. Every test consumes liquidity. Sellers at that level are like soldiers defending a fortress. They only have so much ammunition. With each test, the defending side uses up more of its supply, more orders, more conviction. Meanwhile, buyers gain confidence. They see that the resistance isn't pushing price down as strongly as before. This confidence doesn't only exist in their minds, it manifests on the chart as higher lows, smaller pullbacks, and tighter consolidation near the level. If you watch closely, you'll see these changes happen long before the breakout itself. It's during this stage that the early trader begins to prepare, not from impatience, but from understanding. You must learn to study the quality of each test, not just the fact that the tests exist. Does price reach the level with strong momentum or weak momentum? Does it get rejected violently, or does it hesitate, linger, and return quickly? Does the market form congestion beneath the level, almost as if it's gathering energy? These details matter. They're the difference between guessing and reading the market's behavior. Let me ask you, when you watch price approach a resistance level multiple times, do you look at the emotional undertone of the move, or do you only see the candles? If you want to enter right before a breakout, you must understand that repeated tests give you a timing advantage. They reveal that the battle at that level is growing uneven. A single test tells you nothing except that the market reached a boundary. 2 tests say there's structure. 3 tests start to show intention. 4 or more tests often indicate exhaustion, not of buyers, but of sellers. The market doesn't approach major levels repeatedly without a reason. That reason is often accumulation, the slow transfer of supply into stronger hands. But keep something in mind, not every repeated test leads to a breakout. Some levels hold firm for weeks or months. So what you're really studying is not just the number of tests, but the evolving character of the tests. If the market forms wider pullbacks after each test, that suggests the level is still strong. If the market reacts sharply and immediately after hitting the level, it suggests the defending side still holds conviction. But if the market begins forming shallow dips, tight consolidation, and quick recoveries, pressure is building. That pressure is your signal. There is also a psychological layer to repeated tests. As the market continues pressing into resistance, traders on the sidelines begin noticing it. They say to themselves, "This level can't hold forever." Their attention increases. Stop orders build above the resistance. New buy orders accumulate as traders anticipate the breakout. This creates what I call an emotional cluster, an invisible buildup of energy that will fuel the move once the level finally gives way. Are you aware of how much trading is influenced not just by structure, but by the collective expectations forming around that structure? Time is another element working alongside repeated tests. If price returns to the level within shorter time intervals each round, momentum is increasing. This is often a signal that the trend underlying the movement is healthy. Trends reveal themselves through repetition. If a level is tested once every 2 weeks, then once every week, then every few days, you're seeing time compress. Compression is pressure, and pressure, when combined with structure, often results in expansion, what traders call the breakout. But entering before the breakout requires calm observation, not excitement. Many traders become emotional when they see repeated tests. They either jump in too early, fearing they'll miss the move, or they wait too long and end up chasing the breakout. Your role is to stand in the middle, measured, aware, patient. When you see that the level is being tested repeatedly and the market is forming constructive patterns beneath it, you begin planning your entry near the higher lows, not at the breakout itself. You're not trying to predict a breakout. You're aligning with the structure that makes a breakout more probable. Repeated tests at a key level are one of the clearest signs that the market is building potential energy, and recognizing this pattern is essential for timing your entry before the crowd reacts. Understanding the subtle shifts in strength, rhythm, and sentiment will allow you to see the pressure forming long before the move becomes obvious to everyone else. You watch, you measure, you wait for when you watch a market approach a major resistance level, one of the most reliable signs that a breakout may be forming is the steady appearance of higher lows right beneath that barrier. These higher lows are not just random turns in price, they are like fingerprints left behind by stronger hands accumulating quietly. They show intent, pressure, and a shift in control. Yet many traders overlook them because they seem small, subtle, easy to ignore. But tell me, when you see a market refusing to fall back to old lows, does that not tell you something about the strength working beneath the surface? Higher lows represent a rising floor. Each time the market pulls back, it does so with less force. That means sellers are losing their conviction or at least losing their numbers. Buyers, on the other hand, are stepping in more aggressively, refusing to let price fall too far. Imagine a ball bouncing on a hard surface. Each bounce gets smaller until it stops. But in a market preparing for a breakout, the opposite happens. Each bounce carries the price higher. This is not a coincidence. It's a structural shift. When you see higher lows forming beneath resistance, you are watching demand strengthen in real time. Traders with larger capital often accumulate in these zones, pushing price upward just enough to keep the trend intact without drawing too much attention. They don't want a breakout yet. They want quiet positioning. These higher lows reflect their activity. Have you ever noticed that the strongest breakouts often arise after a clean series of rising pivot points beneath a ceiling? Think of resistance as a lid. The market keeps pushing up into that lid and getting pressed back down. But each time it gets pushed down, it doesn't fall as far as before. That tells you that buyers are absorbing any weakness immediately. If sellers were truly in control, the market wouldn't form these progressively higher floors. Instead, it would retreat strongly and show signs of exhaustion. But when the market refuses to drop, even when given opportunities to do so, that is strength disguised as calm. The key here is the psychology behind these higher lows. Every trader watching the chart sees the resistance. Many of them expect it to hold. When the market pulls back from the resistance, the crowd breathes with relief, thinking the level is safe. But then price refuses to fall lower than the previous dip. This is where the quiet shift begins. Buyers become more confident. Sellers begin to doubt, and doubt is what weakens their defensive power at the resistance. As more higher lows appear, the market becomes like a spring being coiled upward. Pressure builds not just in price, but in sentiment. Traders who were waiting for a strong pullback to buy never get their chance. Traders who shorted the resistance become uncomfortable because the market isn't falling as expected. This creates tension that ultimately contributes to the breakout. Do you see now why these higher lows matter so much? They're the market's way of showing you who really has control. Now let's talk about geometry and structure, something I always valued deeply. A series of higher lows forms an ascending support line, often creating a triangle or wedge beneath resistance. This tightening structure is a visual representation of forces aligning. Price has less room to move downward, more pressure pushing upward, and less volatility overall. When you see this kind of pattern, you're not just looking at lines on a chart, you're looking at energy building inside a confined space. And energy in confinement must eventually release. But entering before a breakout requires careful judgment. You can't simply buy every time you see a higher low. Instead, you must analyze the rhythm. Are the higher lows evenly spaced? Is volatility decreasing? Does the market reclaim lost ground quickly after each dip? These details show whether the structure is healthy or fragile. Let me ask you something. When you watch price form a small pullback and snap back upward with ease, doesn't that show increasing determination from buyers? One of the most important things higher lows reveal is commitment. Buyers show their commitment not by chasing price upward, but by stepping in on weakness. They are willing to defend the trend. They are willing to support price at levels above previous pullbacks. Each time they do this, the market absorbs more selling pressure. So by the time price returns to the resistance again, the sellers are no longer standing on solid ground. Adding the dimension of time enhances your understanding. If the higher lows occur at shorter intervals, the trend is accelerating. If they happen slowly but steadily, the trend is building quietly. Either way, time and price together form a story. The quicker the recoveries from pullbacks, the greater the urgency from buyers. When buyers act with urgency, you are seeing a market preparing for decisive movement. There is also a wealth-building mindset embedded in the ability to recognize higher lows. Patience, objectivity, respect for the market structure. A trader who waits for the chart to reveal its intent is a trader building discipline, a form of wealth in itself. The ability to interpret subtle shifts in trend is far more valuable than chasing large moves. This mindset helps you avoid emotional decisions and align yourself with the true flow of money. As higher lows continue forming under resistance, the market reveals that it is no longer willing to revisit lower levels. This is the same as a river narrowing before it gains speed. Pressure, direction, and energy are coalescing, and as you watch these higher lows stacking one beneath another, you might ask yourself, when you notice pullbacks shrinking as the market pushes toward a major level, you're seeing one of the clearest signs that selling pressure is fading and buying pressure is quietly taking control. A shrinking pullback is like watching the tide advance farther up the shore with each wave. The water still recedes, but not as much as before. It leaves a little more ground claimed every time. Let me ask you, when the corrections in a trend become shorter and weaker, doesn't that tell you something about which side is gaining strength? These diminishing retracements are not just chance fluctuations. They reflect a fundamental shift in the balance of power. When the market is tired, pullbacks deepen. When the market is strong, pullbacks shrink. So when you see price rising toward resistance, but pulling back less and less with each attempt, what you're really seeing is the market preparing to challenge that barrier. It is collecting energy, building tension, and showing you that sellers are no longer capable of driving price down the way they once did. Think of a trend like a long-distance runner. Early in the run, the athlete may take long, deep breaths between strides. But as confidence increases and the runner finds rhythm, those breaths shorten. The pace tightens. Momentum becomes smoother. A market that forms smaller and smaller dips is doing the same. It is settling into a rhythm that favors continuation. Have you ever noticed how some of the strongest breakouts come after a long sequence of shallow pullbacks? It is because the market has been tightening its range and strengthening its core. A shrinking pullback is a sign that buyers are stepping in earlier each time. They aren't waiting for price to fall to previous lows. They see value at higher levels. They trust the trend, and when the crowd begins stepping in earlier, it becomes harder for the market to draw itself downward. Sellers meet more resistance. Buyers respond quicker. The pullback becomes less dramatic and fades sooner. This behavior is not created by emotion alone, it reflects real shifts in supply and demand. When the market wants to reverse, it shows wide swings, deep corrections, and hesitation. But when the market wants to continue higher, it shows shallow dips that quickly recover. If you train your eye to see this dynamic, you'll know more about trend strength than most traders who rely solely on indicators. Indicators never see the story until it's already written. Price sees it first. Pullbacks tell the story in real time. Now, shrinking pullbacks are especially meaningful when the market is approaching a well-known resistance area. The closer price gets to that level, the more selling you might expect. Yet if selling pressure weakens even at this sensitive point, that tells you something powerful. It tells you that the sellers who once controlled that area are running low on ammunition. They can no longer force price downward as effectively. Buyers now absorb those attempts almost effortlessly. Doesn't it make sense that a weakening defense leads to a breakthrough? Consider the emotional side of this formation. Traders who want to buy but wait for deep dips begin to feel frustrated when the market refuses to accommodate them. They start to chase price sooner. This chasing behavior compresses the pullbacks even more. Meanwhile, traders who are short see price creeping back up after every minor pullback, and they begin to doubt their positions. Doubt leads to covering, and covering adds more upward pressure. This is why shrinking pullbacks often precede a surge. They reflect the emotional and financial exhaustion of one side and the growing conviction of the other. Look closely at how the pullbacks behave. Are they sharp or soft? Do they retrace 50% of the previous move or only 20-30%? Do they end abruptly with strong upward bars? All these small details show the market's intent. When pullbacks soften and end quickly, that's a sign of underlying strength. When they stall but fail to follow through downward, sellers are losing their influence. Have you ever seen the market hesitate on a pullback, almost inviting sellers to push it lower, only for price to spring back upward with force? That is the market revealing its true direction. Geometry also plays a role here. Shrinking pullbacks often create rising trend lines beneath consolidation zones. These trend lines guide the move upward with increasing efficiency. They serve as a record of where buyers consistently defend the trend. When these lines rise steadily toward resistance, the market becomes squeezed between upward support and horizontal resistance. That squeeze creates pressure, the kind of pressure that must eventually release. And often, the release happens in the direction of the stronger force, which is revealed by the shrinking pullbacks. But you must also be aware of time. If the pullbacks shrink not just in depth but in duration, the message becomes even clearer. When a market corrects quickly and with minimal distance, it signals urgency. Buyers are not waiting around. They're aggressive, decisive, and confident. And confident buying is one of the strongest forces in market behavior. For a trader aiming to position before a breakout, shrinking pullbacks offer a valuable signal. They show that the trend is becoming more stable, that the market is preparing for a challenge of resistance, and that the downside risk is decreasing. Early entries based on this behavior can give you a favorable position before the crowd recognizes what's happening. But only if you observe patiently. Many traders see a shallow pullback and fear it means the trend is too overextended. But experienced traders know that strength often appears as tight corrections. Understanding shrinking pullbacks also reinforces a wealth-building mindset. It teaches you to respect momentum. It teaches you to recognize when the market is defending its own direction. It teaches you to value subtle signs rather than dramatic ones. Wealth in trading grows from clarity, not excitement, and shrinking pullbacks are one of the clearest, quietest clues the market offers. As the market tightens its movements, forms smaller dips, and refuses to surrender ground, you can sense the energy building. You see the balance tipping, and as you watch those shrinking retracements form one after another, you might start asking yourself, when price and time move together toward the same point on the chart, something meaningful is often taking place beneath the surface. Many traders focus only on price, where it moved, how far it moved, how fast it moved. But price without time is only half of the picture. Time is the silent dimension of the market, the part that shows when a movement is likely to become significant. When you see price pressing into a major level at the same moment a meaningful time cycle completes, you're not just seeing coincidence. You're seeing the market reaching a moment of potential transformation. Let me ask you, have you ever noticed how some of the strongest moves happen, not simply because price reached a level, but because it reached that level at the right time? Every market has its rhythm. Some trends move in cycles of days, others in weeks or months. These cycles aren't magical or mysterious. They're reflections of how long it takes for traders to shift sentiment, for liquidity to shift hands, for expectations to rebuild. When a price level aligns with one of these natural time cycles, the market becomes more sensitive, more reactive. It's like the difference between tapping a rock randomly versus tapping it precisely at its resonant point. One tap does nothing, the other creates a crack. Time cycles are not perfect predictors, but they are powerful markers of potential. They reveal when the market may be vulnerable to change. So when price approaches a significant resistance level exactly as a cycle is completing, you must take notice. A breakout that occurs randomly carries one meaning. A breakout that occurs at the completion of a 30-day or 60-day cycle carries another. The alignment increases the probability that the move is not just temporary noise, but part of a larger shift in trend. Have you ever wondered why markets sometimes break out suddenly after weeks of quiet consolidation? Often, the reason lies in time. Understanding this alignment requires you to think differently. Instead of watching price in isolation, you start asking questions. Is this move occurring early in the cycle, or near its end? Is price reaching this level too soon, or right on schedule? Is the market repeating a timing pattern from previous swings? These questions help you anticipate rather than react. They give you the ability to see the structure behind the movement. When price touches a resistance level at a time when no cycle is completing, the breakout attempt may lack strength. But when a cycle converges with that same level, the market becomes compressed, almost as if it has reached a decision point. This decision does not guarantee a breakout, but it increases the importance of the level. Traders who study both dimensions, price and time, notice that alignment and prepare accordingly. Let's consider the psychological aspect, which is often overlooked. Time influences sentiment. Traders feel pressure in cycles. They grow restless, hopeful, fearful, or eager depending on how long the market has moved without resolution. When a cycle approaches its end, traders begin expecting something to happen. They may not say it, but they feel it. When price reaches a major resistance level at that precise moment, the emotional pressure adds fuel to the chart. It's not just technical alignment, it's emotional alignment. And isn't human emotion one of the strongest forces in the market? Think about how traders behave near round numbers or well-watched levels. Now add the element of time. If price hits that level on a random day, some traders take notice. But if it hits on a day marked by a cycle completion, a 45-day move, a 90-day window, a recurring calendar date, more traders take notice. That increase in attention alone changes market behavior. Markets move where attention gathers.